When markets get noisy, most people look at the wrong thing. They look at the stock price first. They look at the red candles and green candles first. They look at the reaction after hours first. That is understandable because price is emotional. Price moves immediately. Price gives people the feeling that something important has happened. But in my experience, price is only the surface of the machine. The real machine is underneath it. The real machine is revenue. The real machine is cost. The real machine is operating leverage. The real machine is whether management is using capital in a way that compounds value or in a way that creates a large hole that the business then has to climb out of. That is what I pay attention to, and that is why a day like this is so important. In one public account I was watching, the day looked almost calm on the surface. It was not a disaster. It was not a panic. It was what many investors would call a normal market day. But under that surface, some very important things were happening. AMD was showing strength again that mattered, not because one stock was up on one day, but because the underlying system that feeds companies like AMD was becoming clearer with every new earnings report. The largest technology companies in the world were not reducing their spending on AI infrastructure. They were increasing it. They were raising capital expenditure numbers. They were telling the market directly and indirectly that the next 12 to 18 months would continue to send an enormous amount of money toward chips, memory, data centers, and the infrastructure that supports artificial intelligence. At the same time, several popular names were getting punished. SoFi was hit hard. Robinhood was hit hard. Coinbase was hit. HIMS was weak. MicroStrategy moved lower. These are the kinds of days when inexperienced investors become confused. They see one group of stocks moving up, another group moving down, and they think the market is irrational. But markets are not usually irrational in the way people think. Markets are machines that constantly reprice expectations. Sometimes they overreact, sometimes they underreact. But they are always asking a question: what will the future cash flows look like, and how much confidence do we have in them? That is the question I want to hold in my mind as I go through these businesses. Meta reported, Amazon reported, Google reported, Microsoft reported, Cheesecake Factory reported. And then there was another company, a company that the market punished, but whose numbers were telling a very different story. That company was SoFi. I want to walk through this the way I think through it as an investor. Not emotionally, not because a stock is up or down, not because a headline says something. I want to go through the income statements, the spending decisions, the operating leverage, and the long-term trajectories. Because when you understand those things, price movement becomes information. It stops becoming fear. Let me begin with Meta. On the surface, Meta delivered very strong revenue growth. Revenue grew 33% year over year. For a company of that size, that is not normal growth. That is very powerful growth. Among the largest technology companies, it places Meta near the top. Below Nvidia, among the strongest growth stories in that group. If you only looked at revenue, you might think the quarter was excellent. But revenue is not the whole story. In a good business, especially a scaled technology platform, you want revenue growth to translate into operating leverage. That means revenue should grow faster than expenses. If revenue is up 33%, I would like to see operating income grow faster than 33%. I want to see the machine becoming more efficient as it becomes larger. That is the beauty of a scalable business. But that is not what the numbers showed clearly enough. Cost of revenue grew faster than revenue. Research and development grew much faster than revenue. Total costs and expenses grew slightly faster than revenue. Income from operations grew, but not faster than revenue. That is the key point. This is why I would not call the quarter great. I would call it good, but not great. The market is not just asking whether Meta is growing. It already knows Meta is growing. The market is asking whether the cost of that growth is becoming too high, and that is where the problem begins. Meta had a tax benefit that made net income and earnings per share look much better than the operating structure would have suggested. That matters because, one, time items can make a quarter look cleaner than it really is. They can make people focus on the bottom line without seeing the strain in the operating model. But the operating model is what matters over time. A tax benefit does not solve an expense problem. And Meta has an expense problem. It is not a crisis. It is not the end of the company. It is not a reason to say the business is broken. But it is a problem that serious investors need to understand. Mark Zuckerberg has done this before. He is an exceptional builder and he has proved many people wrong. I would never underestimate him, but when a founder with great control over a company decides to spend aggressively, shareholders have to understand what kind of phase they are entering. Sometimes that spending creates the next great growth platform. Sometimes it creates years of pressure on margins, earnings, and free cash flow before the payoff becomes visible. And sometimes both things are true. The difficult part is that investors have to live through the middle. Meta's daily active people number also raised a concern. The company still has an enormous user base. Of course, billions of people use its products. But daily active people were lower than expected and down from the prior quarter. Management pointed to factors like conflict and access restrictions, and those explanations may be valid. But the principle remains the same for a platform business. User engagement is one of the basic signs of system health. You do not want to see it decline. You can explain it. You can contextualize it. You can say it is temporary, but you still have to respect it. Then we get to the more serious issue, capital expenditure. Meta's CapEx guidance had already been aggressive, then it became even more aggressive. The company moved toward a range that could reach $145 billion for the year. That is an enormous number. It is not just a large number, it is the kind of number that changes how the market thinks about the business. The market understands that Meta needs to invest in AI. Everybody understands that. The question is not whether Meta should spend. The question is whether Meta needs to spend this much, this fast, and whether the connection between that spending and future returns is clear enough. With some companies, the answer is easy. With Amazon, when AWS accelerates, the market can see where the CapEx goes. With Google, when Google Cloud accelerates dramatically, the market can see the connection. With Meta, the story is less transparent. Revenue is growing, engagement is enormous, advertising remains strong, but when CapEx explodes and the company does not give investors a clean, measurable way to see the return path, uncertainty rises, and uncertainty is costly. That is why I was not surprised to see the stock move down after the report. The market was not punishing Meta because it failed. The market was punishing Meta because the spending curve is becoming harder to model. That is a very different thing. I still think Meta is a great long-term business, but a great business can be a difficult stock for a period of time if the spending cycle gets ahead of the visible return cycle. That is a principle investors must understand. A stock is not only priced on what a company is, it is priced on what the market believes the next several years of cash flows will look like. If expenses rise too fast, the stock can compress even while the business keeps growing. That is the risk here. It is possible that Meta gets messy before it gets better. I do not say that emotionally. I say it because I have seen this pattern before. In 2022, Meta's stock was hit hard when investors lost patience with spending. Eventually, the company pulled back, improved efficiency, and the stock recovered dramatically. Zuckerberg came through in the end, but shareholders had to endure pain before the discipline returned. That may happen again. Maybe not with the same severity, maybe not with the same decline, but the principle is the same. When the spending machine runs too hot, the market eventually forces a conversation. Now let me contrast that with Amazon. Amazon's report was much cleaner. Revenue grew 17% year over year. Cost of sales grew less than that. Fulfillment grew less than that. Sales and marketing grew much less than that. General and administrative costs even declined. That is what you want to see. When revenue grows faster than most of the major expense lines, the business gets operating leverage. Operating income grew 30% year over year. That is the key. Revenue grew 17%. But operating income grew 30%. That means the machine is getting more efficient as it scales. That is what an A-grade income statement looks like. There was still one line that matters. Technology and infrastructure spending grew significantly. That is something to watch. Amazon too is spending aggressively, but the difference is that Amazon has a clearer explanation for the spending. AWS is accelerating. AWS revenue grew 28% year over year, its fastest growth in more than 3 years. It beat expectations. That matters more than almost anything else in Amazon's report because AWS is the engine that investors watch most closely. It is large, it is profitable, it is strategically essential, and if it is accelerating in the middle of the AI infrastructure boom, then Amazon can justify spending more. This is the difference between good CapEx and confusing CapEx. Good CapEx is not just spending. Good CapEx is spending tied to a visible, growing, high-return business line. That is why the market can accept Amazon spending aggressively. Investors can say, I see it, I see the demand, I see AWS growth, I see why the money is being deployed. Amazon's advertising business is also becoming increasingly important. It is no longer a small side business hidden inside the company. It has become one of Amazon's major profit engines. Advertising revenue grew 24% year over year. That is a powerful number, and it is structurally attractive because the advertising layer sits on top of Amazon's commerce ecosystem. Amazon knows what consumers search for, it knows what they buy, it knows when they are ready to purchase. That is a powerful advertising position. When I look at Amazon, I see a company with multiple growth engines: e-commerce, AWS advertising, logistics, AI infrastructure, and optionality around future services. The market has known Amazon for a long time, so sometimes people become numb to it. They stop seeing how much runway still exists, but the runway is still there. Amazon has spent decades building infrastructure that is difficult to replicate. It has customer relationships that are deep, it has cloud exposure, it has advertising growth, it has a culture that tolerates large investment when management believes the payoff will be meaningful. The stock moved up after hours because the story was understandable. AWS beat, advertising beat, operating leverage was visible. The CapEx was large, but it was tied to accelerating demand. That is a much cleaner setup than Meta. When I think about Amazon, I do not think of it as a perfect company. No company is perfect, but I do think it is one of those rare businesses that can keep compounding for a very long time because it keeps finding new layers of profit inside the system it already built. That is why I treat Amazon as a long-term machine. Now let me move to Google. Google's report was extremely strong. Revenue grew 22% year over year for a company as mature and large as Google. That is remarkable. Cost of revenue grew much less than that. Total costs and expenses grew 18%, which means revenue grew faster than expenses. Income from operations grew 30%. Again, that is what I want to see when operating income grows faster than revenue. The machine is showing leverage. That is the difference between a business that is merely growing and a business that is compounding with improving economics. Google also had a large other income item which made net income and earnings per share look unusually strong. A serious investor should adjust mentally for that, but even after recognizing that, the operating result was excellent. The real story, however, was Google Cloud. Google Cloud revenue grew 63% year over year. That is the number that explains the CapEx. That is the number that allows Google to spend aggressively without receiving the same kind of market punishment Meta receives. If a company raises CapEx and investors cannot see the return path, the stock may suffer. If a company raises CapEx and investors can see a business line growing 63%, the market is much more willing to accept it. This is a principle about trust. The market trusts spending when there is evidence. The market fears spending when there is ambiguity. Google is now showing that its cloud business is not only relevant, but accelerating dramatically. That changes the narrative for years. People questioned whether Google Cloud could become a truly strong competitor to AWS and Azure. Now the evidence is becoming harder to ignore. That does not mean the stock is always a buy at any price. A great business can still become expensive after a major move. I would be more careful. The best time to buy great companies is often when the market is doubting them, not when everyone suddenly agrees that they are excellent. Google had better entry points before this move. That does not mean it is a bad company. It means price and quality are different things. In investing, you can be right about the company and wrong about the stock if you ignore valuation. That is a painful lesson. So with Google, I would say the business execution is outstanding. The cloud acceleration is real. The CapEx is more justified than many people expected. But the stock, after a strong move, should be treated with valuation discipline. That is different from saying it is bad. It is saying the easy money may have already been made from the prior fear. Now let me move to Microsoft. Microsoft also reported strong results, but the picture is more mixed than Google's revenue. Grew 18% year over year. Total cost of revenue grew faster than revenue, which is not ideal. But Microsoft controlled other operating lines well. Research and development grew much slower than revenue. Sales and marketing grew slower. General and administrative costs grew slower. That helped the company still deliver operating income growth ahead of revenue growth. Operating income grew about 20%. Net income grew faster than revenue. Earnings per share grew faster than revenue. That is solid. It is not perfect because cost of revenue pressures matter. But it is still a strong income statement. The bigger issue with Microsoft is CapEx and the growth profile of Azure. Microsoft is also raising capital spending aggressively with huge numbers tied to AI infrastructure and memory prices. That tells us something important. These companies are not stepping back from AI. They are still racing to build infrastructure. They are still buying chips. They are still buying memory. They are still preparing for demand that they believe is durable. But unlike Amazon and Google, Microsoft's Azure growth is not showing the same kind of acceleration. Azure is growing fast, but the growth is not accelerating in the same dramatic way as AWS or Google Cloud in this specific report. That makes the story a little less explosive. Still, Microsoft remains one of the strongest companies in the world. It has enterprise distribution, it has cloud, it has software, it has AI integration through its products, it has enormous cash flow, it has a deep relationship with corporate customers. But the same principle applies. At the margin, when CapEx rises dramatically and the market does not see acceleration that exceeds expectations, investors become more cautious. This leads to the most important second-order conclusion from all these reports. The immediate beneficiaries of this AI CapEx cycle are not necessarily the big tech companies doing the spending. The immediate beneficiaries are the companies receiving the spending. That means NVIDIA, that means AMD, that means Micron. That means the businesses feeding the infrastructure build-out. When Amazon raises CapEx, when Google raises CapEx, when Microsoft raises CapEx, when Meta raises CapEx, that money does not disappear into the air. It flows into supply chains, it flows into chips, it flows into memory, it flows into servers, it flows into networking, it flows into cooling, it flows into data center infrastructure. That is why I would sleep better owning certain chip and memory names over the next 12 to 18 months than owning some of the mega cap spenders themselves. The spenders may ultimately benefit, but the suppliers get paid first. This is a very important distinction. In a gold rush, there are miners and there are pick and shovel sellers. The miners may become rich if they find gold. The pick and shovel sellers get revenue from every miner who shows up. Right now, AI infrastructure is producing a similar dynamic. The mega-cap companies are racing to own the future AI layer. They may be right, They may build extraordinary platforms, but in the near term, they are writing checks. The suppliers are cashing them. That is why AMD strength matters. That is why NVIDIA still matters. That is why Micron matters. Memory becomes especially important because AI systems require enormous amounts of bandwidth and memory. If the largest technology companies are all raising infrastructure budgets, that is not a small signal. That is a direct flow of demand into a constrained supply chain. So when I look at this earnings cycle, I become more confident in the near-term setup for the infrastructure suppliers than for some of the large technology platforms facing margin pressure from spending. That does not mean abandon the great platforms. It means understand where the money is flowing. Now that is how I think follow the flows. Now let me talk about Cheesecake Factory. This may seem like a strange transition after Meta, Amazon, Google, and Microsoft, but I actually like the contrast because it reminds investors that not every attractive business has to be part of the AI war. Sometimes a good business is much simpler. People eat, they go out, they want consistency, they want experience, they want value, they want a place where the brand has trust. Cheesecake Factory delivered a solid report. Revenue grew, food and beverage costs improved as a percentage of revenue, labor expense improved as a percentage of revenue. General and administrative costs were controlled, income from operations improved. Net income rose meaningfully, helped partly by the absence of a prior year debt extinguishment loss. This was not a perfect income statement, but it was strong. What I like about a business like Cheesecake Factory is that the model is understandable. It does not need to spend $145 billion on AI infrastructure. It does not need to convince the market that today's huge capex will produce tomorrow's platform. It needs to execute. It needs to run restaurants well. It needs to expand intelligently. It needs to manage costs. It needs to open concepts like North Italia and Flower Child with discipline. That is a different kind of risk. It is not risk. Free restaurants have labor risk, food cost risk, consumer spending risk, real estate risk, and execution risk. But the system is understandable. If management executes, the business can compound. I like businesses that are understandable. I especially like businesses that can pay dividends and still have expansion opportunities. A dividend is not magic, but it creates cash flow back to the investor. That cash flow can be reinvested into the same stock or into other opportunities. That optionality matters. Cheesecake Factory is not going to become NVIDIA. It is not going to move like a speculative AI stock, but it can be a high-quality compounding asset if bought at a sensible valuation and held with patience. That kind of business belongs in a serious investor's mental universe. Now, after going through those reports, I want to turn to the company that I think the market may be misunderstanding. SoFi, the stock was punished, but the income statement was extremely strong. This is where investors must separate price reaction from business reality. Total interest income grew strongly. Total interest expense grew at a much slower rate. Net interest income grew nearly 40% year over year. That is a very important spread. Dynamic loan origination, sales, securitizations, and servicing revenue grew dramatically. Loan platform fees grew. Total non-interest income grew strongly. Total net revenue grew 43% year over year, moving above $1 billion for the quarter. Those are not weak numbers, those are powerful numbers. Yes, sales and marketing grew at a high rate. That matters. You do not ignore it. But total net revenue still grew faster. Total non-interest expense grew much slower than revenue. Income before taxes grew substantially. Net income more than doubled. Earnings per share doubled from the prior year. That is operating leverage. That is what you want to see. So when a stock drops sharply after numbers like that, the question is not simply, why is the stock down? The question is the market seeing a real risk, or is it reacting to short-term expectations while ignoring long-term compounding? With SoFi, there are real risks. I want to be very clear about that. This is not the same kind of risk as owning a mature software company or a diversified restaurant chain. SoFi operates in financial services. Financial companies always carry special risks because balance sheets matter, credit matters, funding costs matter, liquidity matters, trust matters. A bank-related company can look good until something goes wrong in the wrong part of the balance sheet. That is why position sizing matters. You do not fall in love with a bank or a fintech in a way that blinds you to risk. That is dangerous. But risk and opportunity are twins. The reason SoFi has upside is the same reason it has risk. It is attacking an enormous financial services market. It is trying to become a primary financial relationship for millions of people. It is trying to take share from traditional banks, from fintech companies, from lending platforms, from brokerage platforms, from crypto platforms, and from every old institution that still depends on inertia. Its member base grew to 14.7 million from 10.9 million. That is not small. And it still has a long way to go. If SoFi continues to execute, it could have many times that number over the long term. That is the possibility investors are underwriting. The traditional banks should pay attention. JP Morgan, Bank of America, Wells Fargo, they all have scale, trust, and enormous customer bases. But they also have legacy systems, legacy expectations, and legacy customer experiences. A company like SoFi does not need to defeat them all at once. It only needs to keep taking profitable pieces of the relationship, checking savings, loans, investing, credit cards, student loans, personal finance tools, crypto, stock trading. The more pieces SoFi adds, the more valuable each customer relationship can become. That is the system. The platform account number inside Galileo is also important. Galileo had been under pressure. It had declined, but in this report, it reversed direction and grew. That may seem like a small detail, but sometimes small reversals matter because they show whether a business segment is stabilizing. If Galileo and the technology platform can return to growth while the consumer financial platform continues scaling, the market may eventually have to re-rate the company. But again, this is not a certainty. There are no certainties. The market does not pay you because the answer is obvious. The market pays you when you see a probability distribution better than the consensus and manage the risk. Well, with SoFi, the upside case is large. The downside risk is not zero. That is why this kind of stock can be powerful but must be handled with discipline. When I hear someone say a stock can be the next Palantir, I become cautious, not because it cannot happen, but because phrases like that make people emotional. Palantir was a special case. It had a unique product, a unique customer base, a unique moment in the AI cycle, and a market that eventually changed its mind dramatically. SoFi is not Palantir, but the comparison, if used carefully, can mean something more useful. It can mean a company that the market misunderstands for a long period of time. It can mean a company with a large, addressable market. It can mean a company that is building a system, not just selling a product. It can mean a company that looks expensive on yesterday's numbers but cheap if the long-term trajectory is right. That is the right way to think about it. Do not say, "This is the next Palantir," and stop thinking, say, "What would have to be true for this to compound like a major winner?" Then test those conditions quarter by quarter. For SoFi, the conditions are clear. Members must keep growing. Revenue per member must improve. Credit performance must remain controlled. Funding costs must be managed. Non-interest income must expand. The technology platform must stabilize and grow. The company must avoid taking reckless balance sheet risk. Management must keep executing. If those things happen, the stock can become much larger over time. If those things break, the thesis breaks. That is how I think about it. Not as a story, as a system of cause and effect. I also think about where the market is most emotional. When a stock with strong operating results falls sharply, it often means expectations, positioning, or short-term fears are dominating the price that can create opportunity if the underlying business is intact. But you still have to be careful. A falling stock is not automatically cheap. A falling stock is only attractive if intrinsic value is rising faster than the price is falling. That is the difference between buying value and catching a knife. With SoFi, the report suggests intrinsic value may still be rising. That is why I would pay attention, but I would not ignore the risk. This is the discipline investors need. The same discipline applies to the mega-cap technology stocks. Meta may be an incredible business but facing a spending overhang. Amazon may be a long-term compounder with clearer CapEx justification. Google may have delivered one of the strongest reports, but after a large move, valuation matters. Microsoft remains high quality, but CapEx and Azure acceleration must be watched. Cheesecake Factory shows that simple businesses can still produce attractive compounding. SoFi shows that the market can punish a stock even when the business is growing powerfully. The job of an investor is not to react. The job is to understand. If I look across all these reports, the biggest theme is not just earnings. The biggest theme is capital allocation. Who is spending money, who is receiving the money, who is getting operating leverage, who is losing it, who can explain their spending, who cannot, who has a clear long-term compounding path, who has a story that sounds exciting but is not yet measurable. Those are the questions that matter, and the answers are not always the same across companies. Meta is spending aggressively, but the return path is still harder to see. Amazon is spending aggressively, but AWS gives investors evidence. Google is spending aggressively, but Google Cloud is growing fast enough to support the story. Microsoft is spending aggressively, but investors need to see whether Azure can re-accelerate. The chip and memory companies are receiving money from all of them. That is the flow. That is why I keep returning to the principle of second-order thinking. Most people hear big tech is spending more, and they ask, should I buy big tech? A better investor asks, who benefits from big tech spending more? That answer may be NVIDIA, it may be AMD, it may be Micron, it may be other infrastructure suppliers. The money has to go somewhere. Markets are systems of flows. Follow the flow. The same applies to SoFi. Most people see the stock down 15% and conclude something must be wrong. A better investor asks, what did the income statement say? What did member growth say? What did net revenue say? What did operating leverage say? Did the long-term system improve or deteriorate? If the business improved while the stock fell, that may be opportunity. If the business deteriorated while the stock fell, that may be warning. The price alone does not tell you which is true. You have to do the work. That is why I do not like investing based on excitement. Excitement is usually late. By the time everyone is excited, The easy part may already be over. I prefer to look at companies when the market is conflicted. Conflict produces mispricing. Meta is conflicted because revenue is strong, but spending is out of control. Amazon is less conflicted because spending is tied to visible AWS acceleration. Google is being rewarded because cloud growth is undeniable. Microsoft is respected but watched carefully because growth is steady while spending rises. Cheesecake is simple and steady, which makes it underappreciated. SoFi is the most conflicted because the business numbers look powerful, but the stock reaction was negative and the risk profile is higher. That is where investors can find opportunity if they are willing to think independently. But independent thinking does not mean reckless thinking. It means disciplined thinking. It means asking, what do I know? What do I not know? And what would prove me wrong? For Meta, I would be wrong to become more cautious if CapEx translated quickly into higher revenue growth, higher engagement, and stronger operating income. I would become more comfortable if management clarified the return path and showed expense discipline. For Amazon, I would become more cautious if AWS growth slowed while CapEx kept rising. As long as AWS accelerates and advertising grows, the story remains strong for Google. I would become more cautious if valuation gets too stretched or if cloud growth proves temporary, but the current report showed real strength. For Microsoft, I would watch Azure carefully. If it reaccelerates meaningfully while spending remains controlled, the stock becomes more attractive. If not, upside may be more limited. For Cheesecake, I would watch restaurant-level margins, expansion quality, and consumer demand. For SoFi, I would watch credit quality, funding costs, member growth, technology platform recovery, and whether revenue growth keeps translating into profits. This is how an investor thinks in systems, not emotionally. Not because someone says buy, not because someone says sell, but because the underlying cause and effect relationships are changing. Now let me bring this home. A lot of people think investing is about finding one magic stock. They want the next Palantir. They want the next NVIDIA. They want the next Amazon. They want a name that turns a small amount of money into a fortune. I understand that desire, but the real skill is not wanting the next big winner. The real skill is identifying the conditions that create big winners before the market fully agrees. Those conditions usually include a large market, strong execution, improving economics, a misunderstood narrative, and a management team that can keep compounding through volatility. They also include risk. Every huge winner looks uncertain before it becomes obvious. If it were obvious early, it would not be priced the way it is. That is why investors must learn to sit with uncertainty without becoming careless. SoFi may be one of those uncertain situations. It has enormous upside if it keeps executing. It has real risk if the financial cycle turns against it or if credit problems emerge. The stock can be volatile, it can fall hard, it can rise hard. But if the company continues to add members, expand products, grow net revenue, improve profitability, and avoid balance sheet mistakes, it may become much larger over the next 5 to 10 years. That is not a prediction. It is a probability-based thesis. And it has to be monitored. That is the correct way to think. For the broader market, the same rule applies. Do not become obsessed with one day. Do not become obsessed with after Hor's moves. Do not become obsessed with whether the market was green or red. Look at the structure underneath. The AI CapEx cycle is still alive. The cloud arms race is still alive. The chip and memory demand cycle is still alive. Some mega-cap companies are showing clear returns on that spending. Some are not yet showing enough. Some non-AI businesses are quietly compounding. Some beaten-down fintech businesses are producing numbers that deserve serious attention. This is not a simple market, but the best opportunities rarely come in simple markets. They come when the data says one thing and the price says another. They come when people are looking at the wrong line item. They come when the market is reacting to fear instead of studying the system. So I would not look at this earnings season as just a group of reports. I would look at it as a map. Meta tells us what happens when spending becomes hard to justify. Amazon tells us what happens when spending is tied to accelerating demand. Google tells us what happens when a neglected growth engine becomes undeniable. Microsoft tells us that high-quality companies can still face questions when spending rises faster than visible acceleration. Cheesecake tells us that simple, disciplined businesses still matter. SoFi tells us that the market can punish volatility even when the operating story is improving. And AMD, NVIDIA, and Micron tell us that sometimes the clearest winners are not the companies telling the biggest AI story, but the companies selling the tools that every AI story requires. That is the lesson. The investor who understands flows, incentives, margins, and capital allocation is ahead of the investor who only watches the chart, because the chart moves after the machine moves. I want to own businesses where the machine is improving. I want to avoid or be patient with businesses where the machine is becoming harder to understand. And when a great business becomes misunderstood, I want to have the discipline to study it before the crowd changes its mind. That is where wealth is made. Not by reacting, by understanding, not by chasing, by positioning, not by pretending there is no risk, by knowing the risk, sizing it properly, and letting the long-term structure work. That is how I would think about this market. And that is why, after looking through these reports, the company that most investors may be missing is not necessarily the one with the prettiest after-hours move. It may be the one that got hit the hardest while the underlying business kept moving in the right direction. That is why SoFi deserves attention. Not blind faith attention, because sometimes the next great compounding story does not look great on the day the market is angry. Sometimes it looks ugly, sometimes it looks misunderstood, sometimes it looks like a stock down double digits after reporting strong growth. The question is whether that weakness is a warning or an opportunity. The answer will come from the system: member growth, revenue growth, margin expansion, credit quality, platform recovery, management execution, risk control. If those variables keep improving, the stock price will eventually have to reflect it. If they do not, the thesis fails. That is the game, and that is why serious investing is not about being excited. It is about being clear. Clarity is the edge, patience is the weapon, and discipline is what keeps you alive long enough for both to work.